Welcome to the Allan Small Financial Show. As always, want to thank all of you for taking some time out of your busy day to spend it with us. What an interesting time of the year we are in right now. A lot is going on. We are in the thick of things in terms of earnings season out of the US. We just started getting some reports out of some Canadian companies as well for their latest earnings report. We obviously have a very large presidential election night coming up on early next week that will set the tone, could set the tone for the markets and obviously many other things. Federal Reserve will meet next Wednesday to set interest rate policy as well. We have a lot of economic data coming out. It's just an amazing time. You know, we are just turning the clock over into November pretty soon. And I guess in a few weeks, we'll have U.S. Thanksgiving and followed by Christmas. A lot of people will be spending money in the stores and the malls. A lot more cheer out there, hopefully, and hopefully a lot of people spending money to help grow this economy. And I guess maybe last but definitely not least, we have someone by the name of Taylor Swift coming to town in the next few weeks, which should be fantastic for our economy here in Toronto and the province, and even help some of the numbers here in Canada. So a lot to talk about over the next few weeks, a lot to talk about on our show today. And for that, let's pull up our topics for today. Bank of Canada roller coaster ride continues, roller coaster of rate hikes and cuts. You know, we've seen the Bank of Canada raise rates, 10 times in roughly a year and a half, only to be followed by most recently 4 rate cuts. They hiked 10 times, now they're cutting 4 times. So what's going on there? We'll talk about that. Top 3 things to consider over the next 10 business days. As always, our segment of our top 3 things that individual investors should think about when you decide what you're going to put your money into. Canadian and American real estate in a holding pattern. Interesting enough, we've seen rates come down in Canada pretty quickly already, yet we're hearing that not having much of an effect on the housing market. Maybe the spring housing market will be a different story and much hotter. Canadian dollar dropping. We've seen the Canadian dollar drop a lot more than what we're used to seeing. Usually the Canadian dollar hovers in and around 75 cents, plus or minus 1 or 2 cents. Here we are today, Canadian dollar is under 72 cents. We'll speak about why that is happening and why that is so important. Do we need to worry about an AI bubble? Last time we talked about a tech bubble, and one that bursted was all the way back in the year 2000. We saw a number of tech stocks pull back significantly. Some of them disappeared, like Nortel, for example. And do we need to worry about a bubble that is being led by artificial intelligence? Quick hits. This is a segment of the show where I touch on 3 quick things that you're seeing in the news, give a comment on them, why they're happening, and maybe give a little bit of an opinion. We're going to talk about 3 things, such as oil, for example, that I think people are focusing on in the news over the last, well, let's call it a couple of weeks. And last but definitely not least, your questions. Get to as many questions as I can. Usually we get to 1 or 2 questions at the end of the show. So please, if any of you have any questions throughout the show, please put them in the chat boxes. We will pick them up and either answer them at the end of this show or perhaps on our next show or between shows. I may send a message out to whomever and answer your questions in between shows. So lots to get to today, and so therefore, without further ado, let's move on with the show. I guess the best way to describe what we've been going through with respect to interest rates in Canada is a roller coaster ride. You know, we saw the roller coaster going up for quite some time, and over a year and a half, 25 basis point hike, 50 basis point increases, one after the next, 10 times we saw interest rates go higher in a very short period of time, only to be followed by a very small period of time where Bank of Canada didn't do much at all. They stood pat with where they were at, interest rates at high points, being very restrictive to hopefully bring down the inflation rate. Well, here we are now. Inflation is actually well below 2%. Our last reading at 1.6% here in Canada has now really changed the focus. changed the focus from the Bank of Canada in terms of slowing, I guess, cutting rates on a slow and steady basis to speeding up the rate cuts. I've heard many people talk recently about, so we saw a 50 basis point cut recently, perhaps followed by two more 50 basis point cuts in the coming meetings. And, I'm just not sure what's going on. All we hear about is that the economy is doing well and that GDP, a last reading, in around 2%, although we all know that it's probably closer to 1% on a per capita basis. A lot of the spending that has been happening has been because of all the immigration all the people we brought into Canada spending money, which is obviously helps GDP. But on a per capita basis, we're just hovering around 1%, just above the flat line. So not doing as well as maybe some of the numbers have indicated. And also, when you factor out government spend, we're definitely not doing as well as the numbers are indicating. But we're still okay, right? We're not in a recession, a mild recession. But here we are, cutting interest rates recently 50 basis points. So we've had three rate cuts of 25 basis points each, followed by one of 50. 125 basis points or 1.25% cut off the rate. And so to me, the first question I have is the Bank of Canada know something we don't? I'd like to bring up a point. The Bank of Canada raises rates. They tell us that there's a lag after you raise rates. There's definitely a lag between raising them and the effects it has on the economy, yet they just seem to raise at every meeting, I guess, going against what they were saying, right? That takes 6, 9, 12 months to see an effect when you raise rates. So then why would they raise rates 10 times in a row? Great question. Only now to cut rates 4 times in a row. And the opposite effect, we know there's a lag to that as well. When you cut rates, you won't see the effects in the market for 6, 9, 12 months later. So why has the Bank of Canada been in such a hurry? Why have they taken us on this roller coaster ride? And to me, I think someone's got to call into question the credibility of the Bank of Canada. I'm just not sure they know what they're doing. I know now they're searching for that neutral rate, the rate that they want to set policy at and keep it at so that they're not stimulative for the markets, that inflation would rise again, but not too restrictive for the markets where we could see unemployment start to climb. So they're searching for this neutral rate. And in my opinion, I'm not so sure they know where that is. And it just seems like they want to get there in a hurry. We had a rocket ship on the way up with respect to interest rates. And it seems like we're falling pretty quick at interest rates right now. First couple of charts we have here, Bank of Canada cuts key rates by 50 basis points. This is a great chart because it shows three things. Interest rates going up over the last little while, this last couple of years, then flattening, as you can see in the middle, and then coming down to 3.75. You see inflation coming down from roughly June, July of 2022 all the way to present. You see the dotted line represents 2%, which is the Bank of Canada's target rate. We're now below that. But more importantly, GDP numbers, the purple at the bottom, you can see basically it's been flatlining. We've seen it perk up a little bit in January, in April, maybe a little bit in July. But for the most part, it's been relatively flat. Our next chart is more of a longer-term chart of rates. And you can see going back to 2017 how the rates have behaved. There you go. And again, you can see at the far right, the big discrepancy. The bank rate, Bank of Canada rate, 3.75%. Inflation rate, 1.6%. And, I know we're now well below the 2% target rate. But I think you have to take that a bit with a grain of salt because what we saw in the latest numbers, a lot of that decrease in inflation was due to gasoline prices coming down. I think it was something around the number of 10% reduction in gasoline prices. That's the major reason that we're seeing an inflation rate, a last reading of 1.6%. Food prices, for example, were actually up 2.5%. So gasoline prices made a big deal, and we know gasoline prices is very volatile. Gasoline prices go up next month. Perhaps we start to see inflation pick back up towards 2% again. Our last chart here, again, another way of showing the Bank of Canada. There it is. And I think this one really shows, if you take out all the other numbers, you see the flat line along the top there in the middle, and then how quickly rates are coming down. pretty much as quick as they went higher. And that is why I question the Bank of Canada and what they're doing. Maybe they need to go slower. Maybe they needed to go slower raising rates. Maybe they need to go slower and lowering rates now. It just seems like they're in a hurry to get to where they think they should be, and they're just not waiting for these interest rate movements to take effect in the economy. So I guess we'll have to see what happens at the next meeting, the last meeting for the year. Will they go another jumbo cut of 50 basis points? I'm hoping they don't. I'm hoping we see at the most 25 basis points. To me, it just tells makes the wrong statement for all those that are looking to borrow, to either invest, to buy a home, line of credit. Where is it going to say for our housing market if we continue with these jumbo rate decreases here in Canada? How hot will the spring housing market be? What about all those people that are looking to buy their first home? We have a problem with housing in this country. It's very expensive, especially in the big cities. Lowering interest rates as fast as we have been, in my opinion, it will not help that. We were finally starting to see housing prices come down a little bit more affordable. Yes, interest rates are high, so mortgage rates are high, but nonetheless, housing prices were coming down in certain areas. And I think, and I worry that if we continue to go as quickly to lower rates on the way down as we increase them on the way up, I just think that the Bank of Canada is asking for a pretty hot housing market. And I know that's something that Tiff Macklem does not want. So it'll be interesting to see what the Bank of Canada does at this meeting and the first couple of meetings in 2025, because I think it's going to have a major impact on the housing market. Now the part of the show that I know everyone likes to see, 3 ideas or 3 things that individual investors need to be focused on, in my opinion, before you make your investment decisions. And a lot of times we have similar topics here because economic data is usually very, very important. Earnings are very, very important. We have a new one here, number 3, we'll get to in a second, but here we have it. All eyes on big cap tech earnings. Earnings season has kicked off in the United States. Big banks reported earnings. We've talked about those in the past. Earnings came in pretty strong. But as I mentioned, you really don't have a real kickoff to the earnings season, or at least until you have the big tech earnings, because tech, as we know it, makes up such a large part of the market in North America, especially in the United States. Not as much maybe here in Canada, but in the US, almost 50% of the S&P is tech. And the big tech names, the Mag 7, make up over 20% of the S&P. So all eyes on big tech earnings. We'll touch on that. Multiple economic indicators will set the stage for the next Fed rate decision. We've already had some economic data come out. JOLTS yesterday. We saw GDP numbers out of the US. We're going to get PCE tomorrow. And last but not least, jobs data on Friday. So what is that data going to tell us, and how will that affect our investment decisions? And our third point, U.S. presidential candidate comments and how they impact markets. And we've heard so many comments out of the candidates, right? Whether it's current Vice President Kamala Harris or former President Trump, talking about different aspects of the economy, speaking about different companies within the United States and their thoughts on that, definitely moving stock prices and definitely moving the overall market. So these are the 3 things I think you need to focus on. And let's start, obviously, with all eyes on big tech. There you have the Magnificent 7, Alphabet, Amazon, Apple, Meta, Tesla, NVIDIA, and Microsoft. Tesla reported last week. Fantastic earnings. Tesla reported unbelievable earnings. Stock jumped 20%. Mr. Musk, I think how much money he made that day, I couldn't even count. But last I heard, he was worth quite a bit of money, and hundreds of billions of dollars. And on that day, I'm sure he did quite well. But recently, this week, last night, we received earnings report from Alphabet. And the way earnings work is you kind of want things to be kind of slow, have expectations come into earnings, kind of, not sure, bit weak. People are a little cautious, because if that company then comes in with great earnings, that sets the stage for a nice significant rise in share price. And that's what we saw with Alphabet. We have a chart of Alphabet here, formerly known as Google, or Google makes up a part of Alphabet. Alphabet's the parent company. And you can see on the right-hand side of this chart how Alphabet has fared. Not so well. Really hasn't moved much in the last 6 months or so from a peak in July that they reached. But I'll read out some numbers for you from Google. Operating margin grew 32%. Revenues up 15% year over year. Earnings per share up 37% year over year. Search revenue, that's their search. That's what they get most of their profitability from. A lot of people were nervous about that because of AI, because of the competition from Microsoft and others. Search revenue up 12%, just under $50 billion. YouTube ad revenue up just under $9 billion, well above estimates. Google Cloud. Now, this is the cloud. We've been talking about Google Cloud. The biggest in cloud is Amazon, followed by Microsoft, followed by Google. Google, for a long time, was growing their cloud business 20, then 25%, then 28%. Well, Google Cloud grew 35%, well above expectations. And that's obviously because of the demand in AI infrastructure. So you couple all those great numbers. On the other side, yes, we have some regulatory issues. U.S. government is talking about perhaps breaking up Alphabet or Google into some parts because they have such a monopoly in search and other areas. So there's that risk there. And again, there's the AI risk as well, a risk of artificial intelligence. Are they keeping up with their competitors? So earnings from Alphabet set the tone for a lot of other stocks like Meta, for example. Meta stock as well. But before we get to a chart on Meta, let's go to a company that didn't fare as well, AMD. We have a chart on AMD. So AMD, opposite of Google or Alphabet, they came into the earnings season on a high note. You can see here the trading before, the same day trading. The stock was up almost 4%, up almost $6 a share. And their earnings, where the bar was set so high, they met expectations and even exceeded it a little bit. But because the bar was set so high, investors sold the stock. Stock is down today by quite a bit. They came in line with expectations at 92 cents a share. Their revenues actually were up 17% year over year, beating expectations, but it was their forecast. It was their guide going forward, was slightly below what the market expectation was. Now, Lisa Su, the CEO, has been on TV already this morning talking about their latest chips and how they're going to be great and how they've gained a lot of market share with that. You know, their AI business came into the year. They were projecting $2 billion. They upped that to $4.5 billion by July. And their most recent conference call yesterday, they increased that to $5 billion. So coming in at $2 billion, increasing to $5 billion, that's a fantastic year, yet the stock is not reflecting that. And that is because earnings were predicted to be very, very good. And I guess when you're trading at a multiple, as we talk about on the show all the time, earnings multiples, PE ratios, trading at around 45, 46 times earnings, you're going to have to be pretty darn perfect with an earnings expectation, or what you come out with earnings, with respect to earnings, to warrant that high valuation. And they just did not meet. So these are two companies that I wanted to touch on. Earnings season is so important. And we have a couple of other big tech names. As I mentioned, Meta, we can put that chart up next. Meta chart. We had some great ad numbers out of Google. That should bode well for Meta. Meta here showing at $5.88 a share. But I can tell you that when after Google reported such a dominant number last night, Meta stock went up in sympathy with the Google shares as well. And they were trading over 600 last night. So I'm looking for some good things tonight out of Meta. Maybe the expectation there is too high. We also will see Microsoft tonight. We don't have a chart on Microsoft, but Microsoft will report earnings tonight. Let's see what they say about their AI and their Azure or cloud business. Two other names that we have charts on. Apple reports Thursday. Again, the expectation coming in is high. A lot of people think that they will not meet that expectation. All the things that are going on in China, not sure what's going to happen with Apple. Their China business, sometimes it's good, sometimes it's not good. Doesn't seem to have slowed down from the numbers, but we keep hearing out of China that things aren't going as well. Apple Intelligence being introduced into their products. Are people buying their products now for Apple Intelligence? Well, you need, I think it's the iPhone 15 or 16 to get those products. So we'll see if that spurs on some growth. And our last chart here, I believe that we have is one on Amazon. And we can pull up our chart on Amazon. Amazon's been doing quite well. Stock trading at about $190 a share. Amazon's a bit of everything. And I think with Amazon, I think the key to their earnings release will be how much money they're spending versus how much money they're making. So earnings season off to a great start. We want to look at these big cap tech names for guidance and to see how the stock market will perform and the stock market will behave. Second point I wanted to touch on is the economic data. All the data that has come out and all the data that will come out in the next couple of days definitely will affect what the Federal Reserve is going to do next week at their meeting on the 7th. Data always is going to affect the Fed's decision. They always say they are data dependent. We had JOLTS number yesterday. What is JOLTS? Job openings and labor turnover is what JOLTS stands for. We have a chart on that. And what we want to see and what we are seeing are the JOLTS numbers coming down. These are job openings. We want to see less job openings. When people are moving from job to job, they are perhaps getting more money here, more money there. That is not good for inflation. So we want to see job openings start to shrink a little bit. We had too many job openings, or the US, I should say, had too many job openings, I guess, a few years ago. And it's nice to see that these job openings have come down. Next report we have here, next chart, is a number that just came out this morning. GDP or growth in the US came in at 2.8%, down from 3%. Expectation was 2.9%. Interesting thing about GDP, they actually have something within the GDP numbers themselves. They actually have a PCE number. We're going to have PCE tomorrow, and we can actually pull up a chart on PCE, which is our next chart. But they actually have a quarterly PCE number that gets released with GDP. Not to confuse everybody, personal consumption expenditure number gets released with the growth data that came out this morning. And it actually shows that PCE, or the inflation number, was about 1.5% on a quarterly basis. So that's a really low number. That's kind of like CPI in Canada. Inflation number in Canada was 1.6. So what does that mean for the actual PCE monthly number that comes out tomorrow? We could see a number below 2%, possibly. If that were to be the case, could that lead to another Fed cut of 50 basis points come next week? Or will they just stick with the 25 basis point cut? So economic data is very important. And last but definitely not least, we have a jobs report in the United States. They're going to report jobs on Friday. I think in Canada, we won't report till next Friday. We had 142,000 jobs created in the United States, the month of August, month of September. And what will the October numbers show us? Will they show another big number? We're expecting 100,000 jobs created, and we'll see what they report. So overall, economic data, the Fed is data dependent. We want to see what the data shows us. That'll tell us if interest rates will continue to be cut in the US. Obviously, the meeting for the Fed is not till after the election. So I'm not sure if the election will have an effect on what the Fed does, but we'll have to see. But definitely as an investor, you want to keep an eye on the economic data. Our third topic, which is the US presidential candidates and their comments and how they affect the stock market. And I guess the best examples of that have been former President Trump. He's talked about the chip industry, the semiconductor market, and how Taiwan has basically stolen the chip market from the United States. Not happy about that. He wants chips to be made here in the United States, not here in Canada, but in the United States. And we know a company by the name of Taiwan Semiconductor, the largest global maker of chips, and NVIDIA is their customer, Apple is the customer, AMD is their customer. They can't make chips fast enough to service the needs of all these companies. But here we have presidential candidate talking about how he wants to bring back chip making to the United States, maybe companies like Intel. So we've seen Taiwan Semiconductor get hit hard in the last little while on days where former President Trump speaks about that industry. We've also heard former President Trump talk negatively about Meta, spoke negatively about Google and how YouTube, unfortunately, it did not allow the former president to show some information on YouTube. It was blocked, so he wasn't too happy about that. So every time a presidential candidate speaks about something, whether it's the vice president talking about raising taxes and how that'll affect the stock market, or talking about individual names, that definitely impacts the stock market, and definitely something that I think individual investors need to keep one ear on when you listen to the news. So overall, these are three things that will affect the stock market over the next couple of weeks. And I think three things that you should be focused on before you make your investment decisions. So the Canadian American real estate and housing markets, it's something that we've been struggling with. See some struggles there. With interest rates rising as fast as they have, both in the U.S. and in Canada, still aren't really seeing mortgage rates come down to the point where they're stimulative again. We're seeing a slowdown in the U.S. We've seen a slowdown in Canada, even despite the, I guess now, 4 rate cuts in Canada. The first 3 really didn't do much. The 4th rate cut, did not, well, at least we haven't seen much stimulation here as yet. In the United States, we've actually seen short-term interest rates and longer rates actually move up. We've seen the 10-year now well above 4% in the US. We've seen even the 2-year, the 5-year. All of these rates have now crept back up above 4%, and mortgage rates have gone up with them. And it has been difficult for those that are looking to buy a new home, to buy a home. We've seen home sales not doing as well. And a recent poll actually, that I have here, we learned that 74% of Canadians won't consider buying a house or refinancing until rates fall below 3%. That is the bank rate. Right now, the bank rate in Canada is 3.75. This is according to a Leger poll done in late September for I guess, everyrate.ca, which is a mortgage comparison rate site. So Leger poll saying they need to, or investors need to see a rate below 3%, which would mean another 75 basis points to a full percentage point cut in Canada. And that would take, let's say, prime rate to below 5% or in and around 5%. Maybe that would get people excited again. But I've heard people talk about the bank rate now, perhaps a neutral Bank of Canada rate may be 2.5%. So that would be another I guess 1.25%, 1.5%, 1.75% cut in the rate. And what would that do? Well, that would take us into the 4%, 4.5% prime rate for everybody if they're looking to borrow on a line of credit or for a mortgage. So these are the numbers that we're faced with. So yeah, I guess it makes sense that we've seen a slowdown in housing, and it makes sense that overall housing hasn't come back as yet. Our first chart that we have here regarding the housing activity, housing remains in a holding pattern. There you have it. 10-year monthly moving average. You can see here that home sales were above the average for quite a while, and then recently, I guess what is that? 2021 dropped significantly, and we've seen it drop again in 23 and 24, again below the 10-year monthly moving average. And it's no wonder, right? When you have high interest rates, it's very difficult to see, and it only makes sense to see housing slow down. Very difficult to see an increase in housing. Here you have our next chart, existing home sales out of the U.S. And again, you can see little spikes up at certain points in time. But over the last couple of years, which is what this is, from January 22 to September 24, existing home sales have come down. There's no doubt about that. And that is, again, on the back of interest rates. So as I mentioned a little earlier, if we do see cuts in the United States, bigger cuts in Canada, quicker cuts in Canada, these charts could turn around in a hurry. I think you could see a lot of action coming up in the spring season and springtime, we could see the housing market really start to heat up. And it would not surprise me to see housing prices start to rise again. You make money a lot more accessible for a lot of individuals. There'll be a lot more money chasing very few. We've seen a lot of very few houses up for sale at times. So the supply has been low. If the demand were to heat up, then that's when you're going to see these housing prices start to heat up with multiple offers, as we saw just a few years ago. So my expectation is a very robust housing market come the springtime, on the back of what we've seen already in interest rate cuts here in our country, and what we will see over the next 2 or 3 cuts before we get into the hot selling season for housing. So overall, right now, yes, housing has been, in my opinion, not doing as well. Sales not as well. New builds are slowing. But I think this could really heat up if interest rates were to fall significantly over the next few cuts. Canadian dollar, and we've seen it drop, as I mentioned earlier in the show, top of the show. Canadian dollar has been steadily dropping from in and around 75 cents, which seems to be, in my opinion, on average where it is. Some might say a little bit lower if you take an average over the many years. But we were sitting around 74, 75 cents for a little while there, and now definitely taking a turn for the worse. We have a chart of the Canadian dollar that's actually a little outdated. It's actually below 72 cents now. I know it was slightly higher this morning when I came on air, but still below 72 cents. And why is this so important to me? Well, for obvious reasons. Those that are looking to travel to the US, which is where many travel to, obviously a lot more expensive now to travel. But from an economic standpoint, what can it do and what does it do? Well, first of all, those that are bringing in goods to the country, bringing in, whether it's steel, whether it's aluminum, base metals, product in general from the United States, things become a lot more expensive. You're taking our dollars, cannot buy as much out of US dollars and product from the US. So things become a lot more expensive. And what does that mean for these individual businesses that take these products to make something? Well, that just means that what they're making will cost more. Inflation. If our dollar falls too much and what we're importing costs rise significantly, that could spur on more inflation, something that we've been trying to avoid by raising interest rates and now cutting rates to stimulate. A low dollar could bring back some inflation into our economy. When you look at those, that's on the import side. Our exporters would be doing fantastic. Why? Obviously, when you're exporting to the United States, which is our largest trading partner, the United States can buy more of what we have to offer because their dollar will buy a lot more over here on our side of the border. So if you're an exporting business, a low dollar is great. If you're someone that imports goods or anything for that matter, product in general, that is unfortunately makes things a lot more difficult. So inflation could be affected by a weaker dollar. And obviously on the investment side, for those of us that take our Canadian dollars and go down and buy US, that too, it makes it a lot more difficult. And for those that have US investments, obviously those do a lot better. So Canadian dollar makes a big difference. And why is our dollar falling as much as it has? Simply because we're just cutting rates faster here in our country than the US is. For a little while there, we were cutting rates, Bank of Canada was cutting rates, and it was thought that the US would follow. They cut 50 basis points, but now the talk is at their next 2 meetings, will they cut once or not at all? Versus will they cut 25 basis points or 50 basis points? A different mindset altogether. And that is because their economy is faring a lot better than ours. Perhaps it's because of artificial intelligence. We've seen how artificial intelligence is skewing things, is changing the way we live. turning things upside down, making things, a lot of things better, faster, more efficient. Well, that's what it's doing to the US economy. It's doing that to the Canadian economy as well, but we don't have as much tech here in our economy. We're more based on commodities, oil, base metals, precious metals, things of that nature. So our stock market, for example, has not fared as well in the last few years as the US has. And a lot of that has been because of the tech. Although this year we've been doing quite well since the summer because US dollar was thought to have been coming down with interest rate cuts, and that helped our commodities and the TSX. But back to our dollar itself, it's falling because now the talk is the Canadian interest rates will fall faster than the US, and that could be at some point a point of contention for the Bank of Canada. They're going to have to take a look at this at some point because they don't want to see such a large discrepancy in currency. They don't want to see such a large discrepancy in the overall federal rate, the bank rate, and what that's doing versus the Fed funds rate. So something for Tiff Macklin, I'm sure that he's keeping an eye on, and the Bank of Canada is keeping an eye on, and we will all keep an eye on what our dollar is doing relative to the US dollar in the coming months. Do we need to worry about a bubble with respect to technology and in particular artificial intelligence? And to me, I think this bubble question gets asked quite often. And, every time something goes up quickly or by quite a bit, we always talk, is this a bubble? Is the bubble going to burst? And I guess one of the reasons why we're talking about an AI bubble is for our chart, our first chart here, our only chart for this segment, which you can see here, the forward PE ratios of the Magnificent Seven. And we can see here that they've started to creep higher. Our lowest, as I mentioned, Google, Alphabet. It is the cheapest of the Mag 7, 21 times forward earnings. But you can see clearly that Amazon, Apple, Microsoft, NVIDIA, and Tesla, wow, 90 times forward earnings. These are all well above 30 times earnings. Numbers that tough to maintain. Meta, probably the second cheapest, 26, 27 times earnings. Obviously, we just can't look at PE ratio on its own. You want to look at the companies itself. And I tend to look more at PEG ratios than PE ratios. But PEs are, in my opinion, the reason why we're asking the question, is this a tech bubble or an artificial intelligence bubble that will burst? All these names are using AI. Some of them are producing the chips for AI. Some of them are using AI to better their business, to better their search, to better everything, like Tesla, like Google, Amazon. And so AI has really caused or been the cause of these companies really shooting higher in terms of price of their shares. Price appreciation has really gone up by quite a bit. But when you take a look at their price to earnings, and we can put that up again, versus their growth, you look at an Alphabet, well, yeah, trading at 21 times forward earnings, but there it is. But they're growing cloud at, I said, 35%. Their EPS up 37% year over year. So they're growing at a rate that is well above their price to earnings. So their PEG ratio, price to earnings to growth, to me, makes sense. Maybe you want to own Google at these prices because I think it's relatively cheap. It's growth at a reasonable price. The price is reasonable, even though it's a bit on the high side, but its growth is a lot higher than where the price is trading. Meta, another one. We're going to hear from Meta tonight. Are they going to tell us that they're growing faster than 26%? They're going to be 26 times earnings. Are they growing 30%, 35%? Do they justify a 26 times multiple? Microsoft trades at 33 times. And I think that's why, the stock has been kind of petering out and not moving a lot higher because it's expensive. Apple, we talk about their growth rate being high single digits, yet they're trading at a 32 times multiple. So AI, a bubble? I don't think so. My opinion would be, sure, there are some stocks that are overvalued, perhaps, or slightly overvalued, or maybe fair value at best. However, these companies, unlike previous bubbles that have burst, tech bubbles of 2000, 1999, 2000, these companies have real earnings and real growth, significant growth. Take a look at NVIDIA, right? We've seen NVIDIA last quarter grew over 100%. The quarter before that, over 200%. So is a 41 times earnings justified? Absolutely. For many investors, it's justified. So, you look at Tesla, 90 times earnings. That's a more difficult one. And that's why a lot of GARP investors, growth at a reasonable price investors or value investors, tend to stay away from Tesla. It's more for the momentum players. They tend to be more into Tesla than the GARP investors. So overall, you want to look at all these names. You want to look at, is tech in a bubble? I don't think so, because these names have earnings. They have solid earnings, and in many cases, they actually have earnings that are higher than where the stock is trading, where that price to earnings multiple is trading. And you can tell this very easily by PEG ratio. So all the people that are saying, I won't get involved in this AI, it's a bubble waiting to burst. Well, maybe one day it may come down and may burst, I guess. But I don't think anytime soon. I think the valuations are justified for many of these tech names, and I think they still have room in a lot of them to move higher. Quick hits. This is the part of the show where we talk about 3 things that have caught, I guess, my eye or have been on my radar over the last couple of weeks, and a lot of things spoken about in the news. And I'm sure a lot of you watching today would probably recognize these. Oil dropped steeply with what's going on in the Middle East. Israel's retaliation against Iran. They did not target their energy facilities, and oil prices dropped. We'll show you a chart on that. Canadian government recently spoke about immigration and their cuts to immigration over the next year or two. And now the cuts of immigration, remember, immigration has really helped take in GDP higher in Canada, because we've brought in so many people in the last few years that GDP has gone up with that. Well, now that they're cutting immigration, slowing down the immigration, a lot of economists are having to pull down their numbers. And we'll expand on that. And our third point, what does the US election mean for the markets? What we mean by that is, let's say we don't know a winner come Monday night before we all go to bed. What does that mean for the markets come Tuesday morning? Will they be up? Will they be down? So what does the election mean for the markets? So let's address the first quick hit, which is oil prices. Oil prices have been dropping steadily, exactly like that illustration is showing us. And for a little while there, when Iran sent 280 some odd missiles into Israel, Israel vowed to retaliate. Price of oil spiked. It spiked up well above $70 a barrel, still nowhere near 80, 90, or even $100 a barrel that many were anticipating, I guess, at the start of the year that we would see. But it ran to about maybe $70, $75 a barrel. And now, maybe slightly over, maybe 77. And now with Israel not attacking their nuclear facilities, their refineries, and their energy infrastructure at all, they held their attack to more military positions. Price of oil has not, or really hasn't stopped going down, to be honest. It went well below $70 a barrel, and now sitting in and around $67, $68 a barrel. We have a chart to show exactly that. Here you have on the far right-hand side, you can see the steep decline on the right-hand side that goes right below $70 a barrel. What do I think is going to happen with the price of oil? Well, if you factor out the geopolitical events, you could see maybe oil somewhere around $50, $60 a barrel. I really believe that the geopolitics is keeping the price of oil where it's at. And if you go based on a supply-demand dynamic, and if OPEC plus, which is OPEC plus Russia, were to increase production because they've reduced production over the last few years, you could see the price of oil move significantly higher. So keep an eye on oil. For all of you that have oil investments, oil stocks, definitely something to keep an eye on. Second quick hit I wanted to address, Canadian government immigration. They cut immigration, and that's caused economists to take down their forecasts for GDP, because on a per capita basis, we know GDP has been stagnant. But when you factor in the immigration, GDP has been closer to 2% than the flat line and the 1% level. We have a chart here that shows, I think it's a great chart, actually, one of my favorite charts of the show. This is new immigration policy to slow population growth dramatically, and that's important, right? Here you have natural population is the darker green, so you can see it's not really happening. The permanent residence is in the light green. You can see a forecast there from Desjardins is the black line that's coming down and now starting to go up recently. And then the dotted line is the Bank of Canada forecast. So immigration plays a big part in the economy. How many people we bring in to this country will have a direct effect on how much money is being spent in the economy, GDP growth, how businesses do, and obviously employment, right? It has a big effect on employment. A lot of businesses are upset because they get some of their best workers are people that have come into this country with some sort of background from the country they came from, whether it's a degree or doctors or nurses or someone in manufacturing or whatever part of the economy. So I know a lot of businesses, a lot of small businesses are not happy with a cut in immigration levels. So we'll have to see how this all works out, how it'll affect GDP, how it will affect small business. Dan Kelly has spoken about this recently as well from CFIB, who we had on just a little while ago. So immigration definitely plays a part in the economy. Third point I wanted to discuss, and something that has come up a lot lately, has been what does the U.S. election mean for the markets? And interesting enough, and in an election year, there have only been really very few times that the market hasn't gone up in an election year. I think it's only 2 times actually. And there's a chart we have here. The best election year stock market of the 21st century, the best election years. There you have it. And you can see 2024 is the best. It is the best election year that we've had since the 21st century has come in. I guess the worst is 2008. You had almost a negative 40% return. Now that coincided obviously with the financial crisis, so that is probably why that happened. But usually you see positive returns, and I make I throw out the case. What happens if we don't have a winner come Monday night? What happens if they're counting ballots? What happens if there's a challenge? We've seen a challenge before with former President Trump. What happens if there's a challenge? What happens if it's too close to call? What would the effects be on your investments, the stock market? I got to believe they'll be negative, because with any uncertainty, the market usually does not like it and moves to the downside. So what does an election mean for the markets? It could mean some negativity in the short term until we get a winner, until we understand what the new person in the White House will mean for the economy and the markets. So overall, what does the market look at? They want to see stability. They want to understand if it is a Trump, former President Trump, if he's in the White House, people want to know, okay, increase in tariffs, but a cut in taxes. If Kamala Harris, current vice president, what does that mean? Well, an increase in taxes perhaps, but not an increase in tariffs. So investors are just looking for certainty. So what the markets mean is perhaps some uncertainty. And if that were to happen, I would anticipate the market could pull back in the short term right after the election. Now the part of the show where I take 1 or 2 of your questions that you've asked during the show. Actually, I have one, I think, also that came from last show as well. Let's see here. Yes. What are some common mistakes people make in their investing journeys, and how can they avoid them? Well, I guess I've been doing this for 26 years now. So I've seen what I believe are some common mistakes that individuals make. We've spoken about them on this show many times. Trying to time the market. I think that's the one I've seen recently. Investors asking me, Allan, should I sell before the election and then get back in after the election? Should I sell before a big event and then get in after that event? Seems to be a common question. And Obviously, you can't time markets. You never know what the markets are going to do, how they're going to react to an event, whether it is a geopolitical event, whether it is the election coming up next week, whether it is a hurricane, anything, an event like that. They tend to be short-lived, and the market tends to figure things out and move higher from there. So for me, what are common mistakes people make? That probably would be the biggest one that I see. Take another quick question here. I keep hearing talk about buying what's on sale right now. How do you determine if a stock is good value and on sale? Well, we talk about good value all the time. And I would say right now, things are on sale, but probably not as much on sale as they have been in the past. Markets are at all-time highs. So I think it's becoming difficult for people to buy, individual investors, investors like myself, more difficult to find those diamonds in the rough, those needles in the haystack, those names that are trading fallen angels, things that are really good to look at that haven't gone up as yet. So right now, I think it's a little bit more difficult, but like always, there are always things on sale. How do you determine if it's good value? I like to look at PEG ratios. I like to look at the story behind the company. What are they doing that has made their stock price fall or move higher? Does it make sense? Does it have more room to run up? Does it have more room to run down? Is this a fallen angel? Has the stock moved downward because of information or something that has nothing to do with the stock? Maybe it's a macro situation. So these are all things that I think individual investors need to look at when you're looking at value. And as I said, the PEG ratio, the price of the stock versus the earnings of the company, and that versus the growth of the company. And that gives you a pretty good indication how a company is doing. So with that, I want to say thank you to everybody for watching our show today. It's always a pleasure, and hopefully we've given you some information to take away with you before you make your investment decisions over the next couple of weeks. And as always, we will be back on air 12 noon on Wednesday, November 13th. And promises again to be a fantastic show, information-packed as always, same time, same place. And until then, happy investing.